Welcome to the Daily Block, the top events happening in the past day in crypto and why they matter. Fast, punchy, and brutally honest. Let's go. Volatility shares files for a 5x leveraged XRP ETF. Short version. Volatility shares just asked the SEC to let it create a 5x leveraged ETF tied to XRP, the kind that magnifies daily XRP moves by 5 and uses derivatives and daily rebalancing to do it. This is not for longs who sleep. This product is engineered for intraday maniacs and market makers. Why it matters for crypto investing. 5x leverage creates mechanical buy and sell pressure every rebalance, which can supercharge squeezes and cascading liquidations around XRP. Watch order book depth, funding rates, and whether regulators blink at something this extreme. Risk counterpoint. If approved, it could pump intraday liquidity and volatility. But if rejected or limited by the SEC, the headline alone will already have rattled short-term positioning. Next up, Binance launches a $400 million Together initiative to reimburse liquidated users and shore up institutions. The exchange announced a $300 million USDC retail compensation pool for traders who got liquidated during the crash window, plus $100 million in low-interest loans to institutional partners. It's an aggressive confidence play. Part PR, part balance sheet bandage, designed to blunt blowback and stabilize flows after the carnage. Why it matters for crypto investing. If Binance actually injects material cash into retail accounts, short-term buying power and sentiment could normalize, taking the edge off funding rate spikes and panic selling. Risk counterpoint. This raises moral hazard and selection questions. Who gets paid and on what criteria? And it could encourage riskier behavior if traders expect rescue parachutes. Moving on, U.S. authorities have seized 127,271 BTC tied to alleged Prince Group laundering. Prosecutors filed for forfeiture of the coins linked to massive pig butchering fraud operations, and those BTC are now in U.S. custody pending court process. This is probably the single largest Bitcoin forfeiture to date and throws up big questions about timing and disposal, auction, reserve stock, or long-term government holding. Why it matters for crypto investing. Moving a block that size into government custody is a potential macro supply shock. Traders should watch court filings, auction notices, and any signals about whether the government keeps or sells the stash. Risk counterpoint. Courts and policy can drag this out. An immediate dump is not guaranteed, but even the possibility can affect risk premiums and liquidity expectations. Next, market chaos produced more than $19 billion in liquidations and volatility across BTC, ETH, and alts. Leveraged positions were wiped out in a cascade that pushed Bitcoin into the low 100,000 range and sent Ether and other coins plunging before partial recoveries. At the same time, spot BTC ETFs still saw inflows of about $102.6 million, while some ETH products bled outflows. Quick take, the crash did a brutal cleanse of leverage, but left a hangover of uncertainty. Price action is now being shaped by liquidation resets, ETF flows, and macro noise. Why it matters for crypto investing. After big deleveraging events, risk premiums and funding often normalize, creating range-bound or mean reversion opportunities. Traders should monitor funding rates, open interest, and any remaining crowded one-sided bets. Risk counterpoint. Volatility begets volatility. New levered products or headline shocks can easily reignite another cascade. Speaking of execution risk, Coinbase scheduled maintenance that overlaps a high-stakes SEC decision window for spot XRP ETFs. Coinbase set multi-hour outages and maintenance windows during the SEC decision dates between October 18th and October 25th, including potential trading and derivatives downtime. Coincidence or coordination? It's a terrible look. A major exchange being partially offline when regulators make ETF calls injects serious slippage and execution uncertainty. Why it matters for crypto investing. If an ETF approval or rejection drops while Coinbase can't route orders, price discovery gets chaotic. Traders should pre-position risk, diversify execution venues, and have contingency exits. Risk counterpoint. Maintenance is normal, but event-driven timing makes it a real operational hazard. Smaller exchanges can also suffer, so spread your order flow. Now for global regs. Japan is moving to outlaw and penalize crypto insider trading. Tokyo's SESC and FSA will extend insider trading authority to crypto, giving regulators power to probe illicit gains and levy surcharges, while expanding legal definitions of what counts as insider information for tokens. This plugs a regulatory hole in one of the biggest crypto markets and signals security-style oversight getting heavier. Why it matters for crypto investing. Tougher rules reduce the payoff for pump and dump schemes and informational asymmetry, which can lower speculative alpha but improve market integrity over time. Expect slower listings and stricter exchange compliance. Risk counterpoint. Ambiguity in definitions will invite litigation and gray area trading. Short-term market makers might face increased compliance costs that affect liquidity. Shifting gears. VanEck updated its Solana Spot Plus staking ETF filing, while Akash Network ponders migrating to Solana. VanEck's amended filing shows a 0.30% fee, staking via third-party providers, and a 5% liquidity buffer, so it's trying to package price exposure plus staking yield. Akash publicly naming Solana among migration candidates is a positive adoption signal for the network's developer and DeFi prospects. Why it matters for crypto investing. A US Spot Plus staking ETF would be a new institutional on-ramp that funnels capital into SOL while providing staking income, potentially amplifying price moves and staking participation rates. Risk counterpoint. Regulatory approval isn't guaranteed. Staking mechanics add custody complexity, and competition from other chains could blunt the impact. Finally, Ripple's XRP is showing fresh institutional traction with talks and partnerships. Reports say Bank of America has returned to blockchain conversations, and Ripple just inked a custody partnership with ABSA in Africa to offer institutional-grade custody solutions. That's not moonshots and memes. Those are infrastructure moves that reduce friction for real-world payments and custody. Why it matters for crypto investing. Institutional custody and renewed banking interest lower adoption barriers, which can steadily deepen liquidity and reduce volatility from purely retail-driven flows. Risk's counterpoint. Bank chatter can be cyclical, and partnerships take time to move the liquidity needle. Regulatory headwinds around XRP remain a wild card. Quick trader checklist before you run into the fray. If you trade XRP, watch the 5x ETF filing, the SEC spot ETF decision dates, Coinbase uptime, and Binance's reimbursement flows. Those three can conspire to create violent squeezes. If you use leverage, expect funding to normalize, but avoid being in crowded and one-sided bets right after a deleveraging event. Macro headlines to track include DOJ forfeiture filings, SEC ETF rulings, US-China tariff chatter, and any Fed language. Any of those can swing risk appetite hard. Execution safety. Diversify venues, reduce position size before big news windows, and set contingency exit rules for maintenance and ETF decision days. That's the news for today. Smash the subscribe button if you like your crypto updates sharp, snarky, and to the point. And if you don't, subscribe anyway so you can complain in the comments like everyone else. That's Today in Crypto, where the gains are imaginary and the pain is real.